Good morning, ladies and gentlemen, and welcome to the interim results for Wescoal. Just a reminder that we are webcasting, and those on the webcast, if you have any questions, please do send them through. You can email them through at any time, and we'll take those in the Q&A afterwards. Just before I ask Waheed Sulaiman, the CEO, to start the presentation, I'd just like to introduce Jubilant Speckman from Wescoal, who is the Senior Finance Manager and who's going to be assisting Isak van der Walt today. Isak has a challenge in that he has a bit of laryngitis, and Jubilant is going to be his voice. With that, could I ask Waheed to open proceedings? Thank you, Waheed.
Thank you, Jacques, and welcome everyone to our half-year results presentation. As always, I'm very pleased to be speaking to all of you, and thank you for your interest, and I'm very keen and excited to show you what we've done over the past 6 months. I think, again, it's a good news story for the company, and I think we've been doing very well for a significant period of time now, and I'm keen to share what we've done. So I'll flick through the presentation. So as Jacques mentioned, I'm going to be speaking mainly, and then Jubilant will assist on the financial performance, and then I'll chat a bit about the operational matters and the strategic matters going forward. Isak's on hand to assist with questions as they come up. Okay. So this is a new slide. You may not have seen this slide before. The slide just deals with health, safety, and environmental highlights. And for me, this was just important to show to our shareholders and our stakeholders that we do take health and safety and environmental matters very seriously at Wescoal. It's part of how we operate. HSEC matters are important around sustainability, and we pay close attention to that in how we do our business. So we've conducted a number of interventions and programs at an operational level to make sure that our employees understand what's required in the space, that they understand the risks within which they're working. We conduct normal dust and noise analysis to make sure that we're compliant with the regulation. We also conduct wellness days amongst employees and medical days where it's part of the value add that I think a company can provide to its employees so that employees can be healthy and fit and productive at work. And I think that these things are appreciated by our employees. In the environmental space, so we do know that mining is destructive to the environment, and coal mining is also destructive to the environment. But we believe that mining can add a lot of value to the economy and a lot of value to a country and to society. And we need to manage the destructive effects of mining. So there's a lot of attention paid to the environmental impact of what we're doing. And we continue to strengthen that skills base within the company. And we have appointed key people in an environmental team to help us manage these issues so that we minimize our impact on the environment, and we behave responsibly as a mining company. And I've listed some of the achievements over the past 6 months. So we've got an integrated water use license at Van Katfontein, which allows us to use our discard material as backfill. So what that means is as we mine, we take material out of the ground, which is waste material, and this waste material then needs to be rehabilitated. Right? So what we have engaged with authorities on is taking that waste material and using it to fill the same hole that we've taken the coal out of. And that works from an environmental perspective because you're taking the same material that was in the ground and you're putting it back into the ground. You're not adding any more impurities into the ground. And it also helps the company from a cost management perspective, because what happens now is that you don't need to take that material, move it somewhere else, build a big stockpile and then build a big sort of dump and then flatten it again. So it helps us in managing our rehabilitation costs as well also. So I mean, that's one of the ways where we do think that companies like Wescoal can be creative around how we're good to the environment and also how we improve our profitability. Right, so I'll just touch on some of our highlights over the past 6 months. The backdrop, as I mentioned in June, it continues to be a volatile environment, continues to be an environment where there's lots of change. I do think that there's a lot more optimism in the SA economy now over the past month or so, and we believe that that will bring with it opportunities going forward for just the broader economy and specific companies like Wescoal as well. Coal prices continue to be at multi-year highs, both in rand terms and dollar terms. For me, that's no sort of definite prediction that they're going to continue being high going forward. This just gives an indication of the volatility of the coal prices in the market. All right, so what have we done at Wescoal? We've increased our resource base to approximately 300 million tons. ROM production roughly flat at about 3.2 million tons compared to the prior period, and we'll get into some of those details a bit later. Our revenue again is up significantly, up 28% to over 2 billion rand. If we were to annualize that, we get to a revenue of about 4 billion rand. Cash generated from operating activities significantly up to almost 300 million rand. And our profit after tax also up significantly, about 20% up to 108 million rand. And headline earnings per share also up to 23.5 cents per share. So, some of this, I believe, is to be expected. Because we bought Keaton last year. And the Keaton company, a Van Gaffenfontein mine, formed part of our results for only the last 3 months of the prior period. What we're seeing now is the full impact of 6 months of the Van Gaffenfontein mine. So that does need to be borne in mind. We're seeing some of the benefits flowing through from there. And then also just other benefits from improved operations, cost management, and efficiencies as well. All right, at an operational level, what we've done on this slide is we've broken the slide up into different categories. Elandspruit, Van Gaffenfontein, Webcast project, Universal Coal transaction, which we announced not too long ago, Interbani, and then our Braakfontein. And what I'd like to touch on is just some key elements around each of these sort of operational blocks or units. So we continue to look for opportunities to improve what we're doing and to reduce costs at Elandspruit, and that includes the mine itself and the processing plant. So at the mine, we've looked at opportunities to work together with neighbours to share sort of common boundaries and see if we can't extract more coal in that way. We've looked at moving power lines. That entails working with Eskom as well, also to negotiate with them around moving power lines, and that allows us to access more coal reserves. We've also looked at product mixes and supplying different grades of coal into the market. That helps us to manage our beneficiation costs, so we can produce more coal. It's a lower grade, but our costs of producing are lower, and the economic impact of that is better for us. So there's been some work done in product optimization as well also. So that's the sort of work that we're doing at Elandspruit now. You'd see it's not sort of fundamental groundbreaking changes to that operation. That operation has stabilized now, and what we're trying to do now is to optimize and extract as much value as we can from the asset. At Van Gaffenfontein's now been integrated into the Wescoal group. It's following the same mining process and operating methodology as the rest of the Wescoal mines. We've now completed the design for one of our expansion pits, VG5, Van Gaffenfontein 5, and that's meant to replace one of the other pits that's winding down as well also. We are also in conversations with some of our neighbours about sharing box cuts as we expand into new pits. That would allow us to save significantly on cash flow and to share costs with our neighbours. So that's the, at Van Gaffenfontein we are finding that there are opportunities to reduce costs and to improve efficiencies more and more, and we're looking to take advantage of those. if I could speak about, let's jump to, all right, Mobsvelden. At Mobsvelden, you may recall that Mobsvelden is a project we bought when we bought the Keaton business. And I spoke to you a few months ago about the project work then developing Mobsvelden and bringing it online. So we are making good progress in that regard. We're not at the point yet where we can go to our board and say, here's a final project plan. Where we are with Mobsvelden is that we are engaging with potential customers, which includes Eskom, around their needs, around quality and volumes. And then we are now, once we understand that, we go back and we redo a mine plan and we iterate the mine plan and the commercial effects of the potential sales contracts to determine what's the most optimal way to mine from Mobsvelden and to sell from there. So we are in the final stages of that project development plan. We are hoping to be into coal at Mobsvelden sometime next year, just to give you an indication of the timing there. Right, and as this shouldn't be new, we've got about 48 million tons of reserves at Mobsvelden. We're still looking at between 1.5 and 2 million tons ROM per annum from that mine. We do see significant opportunities for synergies between Mobsvelden and Van Gaetfontein. For example, Van Gaetfontein has got 2 processing plants attached to it. Mobsvelden, in the fullness of time, we think that we would need to build a wash plant there. But as we're ramping up and as we're growing the reserve and the mine, we believe that we'd be able to leverage off the wash plant at Van Gaetfontein already to wash the coal from Mobs. And in that way, we believe we can reduce some of our initial capital requirements. The Universal Coal transaction. In October, we announced that we'd be joining a consortium to look at buying Universal Coal. And we would be acquiring 50% of that consortium. Universal Coal assets are all in South Africa. So they own the Kangala mine, New Clydesdale, and also the Northern Block complex as well also. So our interest at this point in time is at an indirect level. And we'd see through, we'd get the value from these operating mines as a shareholder. So that's how we're initially looking at this. We do see the opportunity in the fullness of time to gain management control at the Universal business. Okay, those are initiatives that we'd be looking to work on going forward. Okay. So Universal, they say that they're going to do roughly 5 million tons ROM production. Our interest at the consortium level is 50%, and that consortium owns roughly, or would, if the transaction goes through, would own roughly 50% of Universal Coal, which then suggests that we'd have a 25% interest at the underlying asset level. The Intabani transaction, we've sold Intabani for 57 million rand. That translated into an after-tax profit number of about 7 million rand. If that, I see Isak and Juby nodding, so that's 7 million rand that's flowed through into our results from the sale of Intabani. We've announced previously to the market the rationale for the sale of Intabani. Intabani was a short-lived mine, roughly 1 to 1.5 years worth of mining left there. We believe that we've sold it for value and that it's value accretive to our shareholders. And it also saves Wescoal management the time of managing a closed mine in perpetuity. So this makes sense for us. It's also aligned to our strategy of owning longer-lived mines going forward. Braakfontein, similar to Intabani, it's not aligned to our strategy. We acquired Braakfontein when we bought the Keaton business. We announced the disposal in August 2018. It's a non-operating asset, so there's no mining taking place there. From our perspective, we would never want to mine at Braakfontein because it's not aligned to the sort of asset class that we at Wescoal believe we want to own. It's based in the KZN area as well also, so it's far from our existing operations. We see little opportunities for synergies there, and that's why we decided to sell the asset. And we are now in the process of closing out. There's 2 remaining conditions precedent linked to that transaction, and those are regulatory in nature. Right, so just on the profitability, and Juby will talk a bit more about these sorts of things later on. All that I want to flag is that there's been a continual uptick in profitability in the company, both at an impact level and at an EBITDA level. We believe that we've been doing really well as a business, and that we see the opportunity to continue doing that going forward. Okay, some of the milestones over the past period which impacted on the performance would have been the Keaton integration, which is now complete and we believe successful. Some of the cost savings we identified early on have been realized, and Juby will touch on how that affected our cost base. We've sold into Barney Colliery, Leo Braakfontein's held for sale, and we're looking at investing in the Universal Coal business. The group structure level, the group structure is still pretty much a mining company and a coal trading business, both of which are 100% owned by Wescoal Holdings. Right now, we own 3 mines. We own Elandspruit, Van Katfontein, and Khanyisa. We own the Mobsvelden project, where we own 74% of that at the project level. There's a 26% minority shareholder in that particular business. We own 3 processing plants. That's 2 plants at Van Katfontein and the Wescoal Elandspruit processing plant, which is the 3rd plant. We've sold into Barney. We're going to be selling Leo Braakfontein. We've mentioned one of the other assets that we do have by virtue of Keaton is the Sterkfontein project. So we have not started much development work on Sterkfontein. We believe that our focus should be on Mobsvelden, getting that up and running and operational. Once that's done, we'll start to apply our minds properly to Sterkfontein and what value can be accrued from there. This value may either be through a divestment process, or we may decide to develop that ourselves going forward. The trading business, we'll see the results from trading have been very encouraging and promising. They've done really well over the past 6 months. And this in a business which, as I mentioned a few months ago, has been streamlined. We've got fewer depots now, we've got fewer people in place, and we're doing better at the profit and the revenue basis than what we had in previous years. So we've got our head office for trading is based in Isando, depots in Pretoria, Benoni and Bellville in the Western Cape, and it's a national footprint from a logistics perspective. Our operations are national, as I mentioned a few minutes ago. So we operate throughout the country. We sell coal throughout the country, and our areas of focus are the Mpumalanga province and also in Gauteng, where our trading business is based. And we believe that we, as a South African company, we want to focus on South Africa now. We're not looking at expanding into Africa or into other parts of the world. If we do want to expand, we think that it would be within South Africa's borders at the moment. To give you a sense of the size of our business, so we employ 53 employees, just over 1,000 contractors, and that's a function of the operating model that we do have at Wescoal, where at the moment we outsource all of our contract mining activities. That helped us before in the sense of managing our cash and our balance sheet exposure as well. These, the mix between employees and contractor, or in-source versus outsourced, is a conversation which happens continuously within Wescoal. And we may find that as we grow as a company, we want to change that mix, but this is where we are right now. Our mine lives are fairly long at this point in time. Elandspruit's got the mine life of about 7 years, Van Katfontein 11. We believe the Mobsvelden project, which will come along, as I said before, next year sometime, would have a mine life of at least 15 years as well. Also, Khanyisa is getting towards the end of its mine life. It's got 3 years worth of mine life based on the current reserve and the current mining rate. Okay. I'll flip to the next slide, which will give you a sense of how the relative contributions of the mining and the trading companies. So you see that mining by far contributes the most revenue to the group, and also the most EBITDA contribution to the group as well. And you'd also see from the relative percentages of trading where the revenue contribution is 38%, but at an EBITDA level only 17%. And the reason for that is that the margins in the trading company are much smaller than the margins we make in the mining business. And that was part of the justification for us about a year or two ago deciding to streamline and right-size the trading company so we spend an appropriate amount of management time on trading and mining. We have, with the Keaton acquisition, increased our exposure to Eskom. So previously we were about 40% of our business was Eskom business. Right now it's about 50% Eskom and 50 other. The reason for that is because Keaton's mines only supplied into Eskom, so we're seeing the effect of the Van Gautfontein sales into Eskom coming through. I wouldn't say that I'm particularly uncomfortable with that mix. It feels about okay. There's no specific target that we're aiming at, but we are relatively comfortable with that mix at the moment. Okay, this again just shows the growth in the mining company, which, for me, it goes to show the track record of the management team and the track record of the company, which I think can be used to infer future performance going forward. At the beginning, I mentioned to you that we wanted to highlight to you the importance of safety and environmental matters to us. These are just some of the stats which support that. So our lost time injury frequencies are being managed quite well. We're not seeing any indicators of an operation that's out of control. One of the indicators of an operation that's out of control is if you start to have many incidents. That suggests that people are doing things which they're not supposed to be doing. And we're not seeing that. And that means that our operations are stable. And more importantly than that, they're also safe, which is very important for us. Our sales tonnages, they increase marginally. That's because of the Intibani sale. So we sold Intibani 3 months into the year, so sales from Intibani are not part of the numbers, although we've booked the profits from the Intibani sale. Excuse me. Our diversity of revenue streams, that continues to be important for us. Continues to be important for us to be able to identify and to seek out new opportunities for revenue, to widen that base as much as possible. And we do see, we can continue to build on that going forward as well. Some of the projects we're looking at, Marbsvelden, which I've spoken about, the 2 expansion pits, 5 and 6 at Van Gautfontein, and then potentially down the line, the Sterkfontein project. The trading division, as I said before, has performed really well from our perspective. We've spent a lot of time increasing the skills base of our employees to make them more efficient and more productive. And what we found is that we've increased our sales by 15%, revenues increased by 36%, and we've managed to keep margins stable at about 10%. So we shouldn't underestimate the importance of the statement about keeping margins stable. The operating environment in South Africa has been really difficult over the past 6 months. Input costs into businesses have increased significantly. The cost of diesel has gone up significantly. Cost of explosives has gone up significantly. These are all very large cost components for mining companies and companies that use logistics to deliver their product, like the trading business. So for the trading company to maintain its margins at about 10%, for me that's exceptional and also noteworthy. At this point, we're moving on to the financial performance section of the presentation, and Juby will take us through that.
Thanks, Waheed. Good morning, everybody. As Jacques has actually mentioned, that I'm going to be the voice for ISAP today. I'd like to take you through the financial highlights. Some have already been mentioned at the beginning of the presentation. Our revenue for the period has increased by 28% to 2064 million compared to 1061 million in the prior year comparative period. Operating expenses have decreased by 21% to 104 million. And I just want to highlight the costs that we're referring to here are not the production costs, but they come below the gross profit line, and it's mainly our overheads. And this was as a result of lower salaries during the period, mainly as a result of Keaton integration that Waheed has already mentioned. Our operating profit, as a result, increased by 23% to 197 million. And NPAT, as reported, increased also by 23% to 108 million. Cash generated from operations, we've seen a significant increase here by 41% to 291 million. And that was mainly as a result of, obviously, the increase in revenue and also improved management of our receivables. Very conservative conservative gearing ratio of 18%. Capital has been retained for growth for the projects that Waheed has also mentioned. Net current assets have increased by 336 million compared to the prior comparative period. And then headline earnings have increased by 16% to 23.5 cents. I'll make reference to that in another slide later. I'd just like to give a bit more detail in a few line items mentioned on the slide. First, the ROM production has increased by 3%, and mainly that's because of the Van Gaatfontein. Now we're seeing 6 months production being included in our results instead of 3 months compared to prior period. There was a delta in the Khanyisa production, as we've previously announced, due to differences in opinion in the joint venture partners on how the revenue of the venture should be marketed. And then Elon Spread's production during the period has normalized. The revenue, as I mentioned before, increase of 28%. There was a significant increase in the trading revenue from 593 million in the prior period to 808 million in the current period. Mining revenue also increased from 1063 million to 1325 million. The gross profit increased by 3%. The main contributing factor there is because of sales mix. We generated more revenue from Wescoal trading compared to the previous period, and then also more transport revenue. And these types of revenue have a lower margin compared to our coal sales. The other contributing factor is higher than inflation increase in our input costs, which we've tried to manage as well during the period. I'll skip down to the last line, the distribution to shareholders. This has previously been reported. We declared a final dividend and paid a final dividend of 35 million for the 2018 financial year. On the next slide, I've already touched on the first 3 lines, so I'll move down to net finance cost. You'll note a 46% increase in our net finance cost, and that is because of the funding for the Keaton acquisition. Our tax charge, 52 million, which is a 8% increase from prior year, but that is equivalent to an effective tax rate of 32.5%, which is as expected. EPS, 12% increase compared to headline earnings per share increase of 16%. And the main difference there between the EPS and the headline earnings per share is because of lower other income that we've generated. Just to show you, and you probably have seen this before, from FY14 to FY18, our headline earnings per share, we're seeing a 32% 4-year growth trend from 2014 to 2018. And then the 3-year growth rate from FY15 to FY18 is then at 44%. Period-on-period growth from first half 2018 to 2019, 16% growth. Our revenue, 96% growth trend, 4 years. And then if we have a look at our operating profit, a 23% increase from half year 2018 to half year 2019 to 197 million, and as I've mentioned before. Cash flow generation. We're seeing here a 56% increase over a 4-year period from 2014 to 2018. And then if we have a look at our cash flow generated from operations, a growth of 41% from 206 million in the prior comparative period to 291 million in this period. And this equates to 66.8 cents per share cash flow generated. And I also just want to highlight that the cash generation yield from this is about 30% for the period and then 60% annualized. If we have a look at our segments, as you've heard before, we have 2 main segments, the mining and the trading. Just want to illustrate here the growth in revenue, as I've mentioned before, for mining from 1063 to 1325, and then external revenue 1.2 versus 1 billion there. And then on the trading side, an increase from 593 million to 808 million. Also, please note the 56% increase in the operational EBITDA from the trading division, which has been a significant contribution to our results. In the current year, we've invested 45 million in CapEx compared to 37 million in the prior year. The main component there, the 50%, is the deferred stripping asset. We've spent about 23 million there. Although we've capitalized 23 million, we've actually amortized about 33 million in total year to date, of which 20 million is short term. If we flip over to the statement of financial position, and I'll start first with the assets. We'll have a look at our non-current assets. Property, plant and equipment has decreased by 217 million compared to year end, and that's as a result of the disposal of Intibane. RBC now being held for sale, and it's disclosed separately there at 122 million. And then that's mainly it. And then obviously the depreciation that we recognize in the period, and the additions that I made reference to in the previous slide would also be part of this number. Inventories have remained, it's not, it's about a 40 million increase, which is mainly relating to Asterlinks. Trade and other receivables compared to financial year in 2018 have decreased by 107 million, and that's as a result of improved management of our receivables. Non-current held for sale, I've already mentioned, that is LBC. Our total shareholders' funds, 1.1 billion there, and the main movement from the balance reported at year end is as a result of our profit. Then we declared and paid a dividend of 35 million, and then there was also the share buyback as reported of 11 million. Our interest-bearing borrowings in total, if you have a look at the non-current and the current, in total they've reduced 147 million, which is 30% reduction in debt. Our rehab provision has increased from 495 million to 504 million, and that's as a result of unwinding for the 6-month period, and then the reduction is as a result of disposal of Ndabane. Our net current assets have increased by 179 million during the reporting period, which is from year-end March 2018, and 336 million since September last year. A statement of cash flows, a number that we're very proud of. During the period, we've generated cash from operating activities of 291 million compared to 206 million in the previous comparative period, which results in a 41% increase. PPE that I've mentioned that we've invested, I mentioned 45 million, it's included in there. The proceeds from disposal of Ndabane are reflected over there in the 57 million. We've also invested 11 million during the period in rehabilitation funds, as Waheed has mentioned the importance of the environmental aspect in mining. If we have a look at our cash flows from financing activities, our interest-bearing borrowings have reduced by the 147 million, and the dividends and the share buyback together during the reporting period are a total of 45 million. All this results in a net cash generated of 48 million for the period. If you look at the next slide, we try and just reflect the value, how we've utilized the value that we've generated during the period. So we've generated a total value there of 1.9 billion. Significant portion being contributed to our contractors, as we mentioned that we are mainly contract mining, 44 million in staff costs, 16 million to our communities with our social labor plans, 19 million finance costs as reflected in the statement of comprehensive income, government, which is mainly tax, income tax expense, and then 44 million to shareholders, which is the dividend and the share buyback. At this point, I'd like to hand over to Waheed. Thank you.
So Juby being here is also a function of, we spoke at length before about strengthening the management team and improving the skills base within the company so that we manage succession planning a lot easier. And the reason we could manage Isak having a medical emergency today is precisely because of that. Juby could step in. She joined us not too long ago. So thanks for that. We appreciate it. In terms of a strategic update going forward, we're going to maintain our focus on providing stable operations, safe operations, predictable operations, and we believe that that will result in really good financial outcomes for shareholders. Okay. We're going to continue focusing on our competitive advantage as an HDSA business. We're going to continue looking at opportunities to expand, to consolidate, and we're also going to continue looking at opportunities to diversify our revenue streams, however we may come across them in the coal value chain. Some of the achievements we've gone through over the past year, maybe repeating what I said earlier, is we've increased our processing capacity through tolling arrangements and wash plants in the areas where we've got mines. That allows us to increase our saleable production without necessarily having to invest large amounts of capital in new wash plants. Okay. We've increased the flexibility because of our enlarged resource base through the Keaton business. Trading volumes have increased significantly. We've started working on acquiring the Universal business. We're disposing of assets that are non-core to us and assets that we believe don't add value in the long term. And then again, just to flag what Juby mentioned about the cash flow generation within the company, We've got cash flow generation of 25% over the first 6 months, which we believe is exceptional and also repeatable going forward. Some of what you may be interested in, what is it that we want to focus on going forward? As I said before, the revenue diversification strategy, we're going to keep focusing on that. We're going to look at options around marketing, infrastructure, mining services as well also. So I touched on earlier sort of the concept between insourcing versus outsourcing. So we may want to re-look at that, whether the current model is still correct or whether we want to change or tweak some of that going forward. That's some of the things we're thinking about. Mobsvelden is our key internal growth project. So we're spending a lot of time and effort trying to make sure that we get it done correctly. So it's not about rushing it into production to try to take advantage of maybe a short-term opportunity around price that may be in the market. It's all for us about making sure that we develop the mine plans properly, get the most economic value we can out of this resource, and then after that, once we've got the solid, proper plan, to deliver against that plan going forward. Right, as I mentioned before, synergies from Van Gaetfontein. We do see opportunities for that at Mobsvelden. We're going to take advantage of synergies across the group wherever we see that. We've already extracted more than 40 million rand of overhead costs from the Keaton business which we acquired, which we promised to the market 18 months or so ago. We've realized that now and we're seeing that coming through. And we're also seeing the benefits of that when we look at comparative costs. We've got significant debt facilities in place, strong cash flows. This enables us to look at growth opportunities both internally and externally, and to have the ammunition to take advantage of them. Now, we are in the middle of refinancing conversations with our bankers around debt across the group, and that's because prior to the Keaton transaction, we had secured funding from Nedbank to optimize the funding across the Wescoal assets. So what we're doing now is we're wanting to optimize the funding across the Wescoal assets plus the old Keaton assets. We believe that when we do this, we should get reduced rates and we should be able to get increased funding capacity across the company. Right, and then just to end up our operating model, we believe enables sustainable, stable growth and allows us to create a scalable business where as we continue growing, because we do believe we're a company that wants to grow, we've set up a business where we can sort of plug and play new mines and new assets into the existing model. And I think from my perspective, the Keaton transaction has shown to me that we have done this and that we've done it successfully and that we can continue doing this going forward. The share price and an illustration of our market cap, which goes up and down with the share price. And then we've got the concluding slide where I'll just read the quote ascribed to me over here. It says, "We are pleased with the operating performance, production and sales from the broader asset base in the first half. The management team has consistently progressed the disposal of non-core assets and actively sought out acquisitive value-enhancing opportunities in line with our strategy. The company is solidly on track to meet its production targets and is well positioned for steady, sustainable growth." So on that, maybe at this point, Jacques, I don't know if there are questions that you can manage for us.
Yeah, thank you, Waheed. Just a reminder to those on the webcast, if you have any questions, please do send those through. We're going to take questions from the floor first, and we're going to open up with those right now. So if there are any questions, please remember, do speak into the microphone so that the webcast can also hear you. Are there any questions first up?
Results that they produced at the end of September. I'm not sure if this is the right forum, but would you like to avoid a little bit of, because according to their results, Keaton has got a claim of 92 million against them, or they provided for 92. The claim has gone up to 145, and they further mentioned that there's no further recourse for them. Is there any update that we can be provided with?
Okay, thanks for that question, Luan. So I am aware of that particular paragraph in the Unicorn results. I didn't attend the presentation. What the matter is in the courts, and they have provided for the amounts that you've indicated. From my understanding is that based on the advisors that I've spoken to, the fact that you've provided for something doesn't necessarily mean that you're going to end up paying that amount of money. So we do have our court process where we are progressing our matter against Unicorn. It links to the Megacube dispute with Keaton. So it's a situation that Wescoal has bought into through the Keaton transaction. And we may or we may not recover 90 million rand or a portion of it. That is just something in the fullness of time that our court processes would determine for us. And then I guess further on top of that is the likelihood of recovering any money from the Megacube business or from Unicorn. But what we will look to do is to pursue our rights as aggressively as possible and to recover our damages which we are entitled to the furthest extent possible allowed. Does that answer that?
Thank you.
Keith McLaughlin of Wealth. Waheed, just a quick question on the mining segment. The bottom line profit seemed a little bit light, but there's obviously this. My interpretation is this is largely driven by the disposal of Interbani. Higher margin, shorter life, improving obviously the profile of the portfolio there. On a like-for-like basis, so annualizing Interbani or excluding it from the previous numbers, what would the segment have looked like on a bottom line basis?
So it's difficult to, and maybe Isak or Joby can also support, right? But it's difficult to give an exact number because we've sold it, right here. But you are correct in the sense that the profits that we would have booked from an Interbahn is now not in here. And when we sold it, we get the value not just from this year, but as you said, the portfolio going forward. So it has had an impact on our operational profit levels in the mining company. I am, maybe Isak can share a bit more about what we think it could have been if it was part of the business.
Thank you. I'll try and bear with me. So the profits from the Interbani business is never disclosed separately, really, to the market. But clearly we had disposed of that early in this half year, so it had an impact. And I'm cautious to quantify it too specific for you, but to maybe put it percentage-wise, that it could be 10% of the result. It's not a major contributor, but it does did have an impact. Taking it forward, looking forward, the Interbani mine would have, by default, ran out by the end of the financial year, roughly speaking. So on a continuous basis going forward, it doesn't have an impact to the value of the company. The benefit that we have from that, which is not reflected in the financial results, is avoiding the rehabilitation cost. So there would have been rehabilitation cost of, well, again, I'm not quoting specific numbers, but you might find it in the CPR even. But there would have been significant rehabilitation cost in the last year, and that's part of the logic of reasoning. The other is just avoiding the complications of closure. Passing it on to a responsible person. So that frees up capacity really of management to grow the business in other spaces where we're heading towards. And some of the projects we spoke about today around Moabsvelden, additional pits to the Van Gratfontein mine, is all of the opportunities that we're looking at to expand the volume base and as such to more than make up really for the production that was taken out by the disposal.
Just touching on Kanyisa, obviously there's a bit of conflict there with the JV partner, and you guys are talking about resolving it. Do you expect to resolve it in the second half? Operationally, is the mine still running? So are they stockpiling? Because this seems to be a marketing or route to market conflict. So is there a stockpile growing there such that when this gets resolved, there will be a flood of sales and profits coming out of that asset?
So we believe that we will resolve the situation with our partner in the second half of this year. We've made progress already on that front. And it has affected our results. Mining continues, but you can only stockpile up to a certain point when there's no more stockpile space available. And then you've got to sell some of the stockpiles to make more space again. So it is placing pressure on some of the mining activities, and that's why you pick up in the results. The Kanisa numbers are a bit muted compared to last year. So there is pressure there. We are looking to resolve the matter as soon as possible. We are mining at Kanisa, but probably not at as fast a rate as what we would like to be able to mine at.
On the LBC asset hold for sale, do you expect the proceeds to come in the second half of the year?
I would like to. I can't guarantee it because it depends on consents from the DMR. And while we will do what we need to do, there's no specific time frame for the authority to come back with a consent. So we're aiming for this second half, but I can't guarantee that it would.
Then on your P&L there, the finance charge was obviously relatively high versus the comparative period last year, and that's the debt brought on from the Keaton acquisition. Yeah. But you guys have also quite aggressively de-geared and paid off a large portion of this debt during this period. So would it be a fair assumption that we would have a materially lower finance charges coming through in the second half of the year? Sorry, Isaac. I keep on making you talk.
100%. Thanks again, Juby. You did a great job. So there's merit in it, definitely. So the finance charge month to month is coming down. We do have, obviously, acquisition plans going forward. So depending on the timing of all of that, the cash balances might move if we close the transaction and pay out for the universal acquisition. The other element to include in that equation is it's a technical accounting IFRS method of accounting for rehabilitation cost. So the rehabilitation provision is discounted at a net present value on a balance sheet as it should be. Every period that gets unwound, as we refer to it, excuse my lingo, and that is reported as part of the finance charge. So there's a big portion of that in there as well, which is non-cash, and it could be in the region of 20 million rand that sits in that account as the interest charge, and that will remain.
Thanks very much, guys. Sorry, Isaac.
No, good.
Thanks, Keith. Any other questions?
Hi, Waheed.
Hi.
Congratulations on the results. It ties into one of the questions I think that's been asked already, but your gross profit margins have gone down, and as a result your GPs went up by 10 million because of the increased sales, but the margins were down. And it appears as though most of that GP margin decline has come through from the mining area because the GPs were pretty stable in the trading environment. So that's obviously, I presume, coming through in your cost of sales, which have gone up very significantly, which is then, I presume, your contracting costs. And what's driving that?
I can give you some answers. In the SENS announcement, we also do refer to that. The reduction is in 3 or 4 categories. As you mentioned, the Wescoal trading business's margins was more or less stable, but they did decline a little. They're still above 10%, but it was a little lower than the previous year, maybe half a percentage point or so. In addition, we've seen that the trading revenues had grown substantially from 590 to 808 million. So there's a large portion of our revenue that's come in the additions at a lower margin. The other element of it is what I mentioned earlier, the delivery transport margin. When we deliver coal to our customers, the revenue from that source had also increased. So the mining company or the mining segment, the total revenue increase was 260 million. About 80 of that, or close on a third of it, comes from transport revenue, where the margin is very slim. Hence, we see the revenue go up by more than what the cost base does, or the margin, and there's a gross profit margin squeeze as a result. The other element to also acknowledge is that we did have higher than inflation cost increases on input cost, and the easiest one is really on diesel. I feel it myself. If I fill up my car, it's very expensive now. So that had costed us a lot, and that squeezed down the margin, as did the cost of explosives and other direct input costs.
Yeah, and then also just to add on to it, this lesser effect is Van Gautfontein now in for 6 months. margins there are slightly lower than at the Elandspreit operation also.
If I can add on, thank you. That's an important element. Frankfurt-Fontein was acquired in terms of a business acquisition. Again, it's on that international financial reporting standards methods. According to that, the purchase price allocation was properly done, as what we reported on previously, and that had assigned the fair market value of Frankfurt-Fontein resource at the time of acquisition as being our cost base going forward. What does that mean? The asset is valued a bit higher than it would have been previously in the Keaton Group, and that value gets depreciated as you go forward. As a result, the Frankfurt-Fontein margins is lower than what the internal Wescoal developed mines are.
Thank you, Isak. Gary?
So I can assume that the dividend, the interim dividend is possibly on hold, if not on hold, and also the share buyback. I can assume that you guys are going to sort of try and keep as much cash as possible in light of the Universal acquisition. Is there a timeline that's been put out yet, or some sort of progress report on the Universal acquisition and how it's going to roll out for 2019 and what's happening with it?
So there's no public timeline around that yet, Gary, and the buybacks and the dividends, and those are conversations with the board around capital allocation, but it's probably a fairly safe assumption that you're making there. As soon as we get confirmation from Universal about timelines, we can then communicate that. So we are an investor in a consortium, and the timelines are being, to a large extent, driven by regulatory requirements in Australia around their listing in Australia. So at this point in time, I can't give you definitive timelines other than to say that in the first part of next year, we expect to see some movement around the transaction.
Thank you, Waheed. Just a reminder before we close out on the open forum, if there are any questions on the webcast, please do send them through. I see there's about 14 or so investors on the call. Natasha, can I just check with you if I'm reading this correctly? There's no questions at the moment. Okay. Are there any further questions from the floor?
Is the intention to finance the Universal acquisition through your own internal cash resources? Is that the intention, or is it there's no share placement or anything like that likely? Or?
The base intention, right, and things change of time. Right now, the intention is to use our own cash and to use debt facilities. There's little, at this point in time, again to emphasize, little likelihood of us wanting to use Wescoal script to fund the transaction, to fund this phase of the transaction in any event. It may change as we look to acquire the entire company, but right now, no.
Are there any further questions from the floor? So that concludes this morning's proceedings. Thank you for joining the Wescoal interim results. And please do join us and the management for a light finger lunch. Thank you very much.